How and when a refinance is helpful. After several years of elevated mortgage rates, steady declines have made more homeowners candidates for refinancing. But a smart decision requires looking beyond the headline interest rate. The first question is whether the refinance actually reduces the rate, and if so, what third-party closing costs and discount points are involved. Every mortgage carries these costs, and paying points may not make sense if rates are expected to fall further and another refinance could be on the horizon, especially since few 30-year mortgages last their full term before a sale or another refi. The structure of the new loan also matters. Should costs be paid up front or rolled into the loan balance? And how long will the loan likely be kept? The real goal is to borrow at the lowest overall cost over the life of the loan, factoring in both the rate and the cost to obtain it. A lower rate and payment may feel like a win, but without careful structuring, it may not be the most cost-effective move, something mortgage brokers often overlook when focusing solely on rate reduction. Here's a real-world example from just last week. A homeowner with a $580,000 mortgage at 6.875% and a $3,900 a month payment has the opportunity to refinance to 5.5%, lowering the payment to $3,500 with no additional cash due at closing, saving roughly $80,000 in total interest over the life of the loan. At first glance, this looks like a no-brainer. However, this structure would only be ideal if the homeowner never had a chance to refinance again, which is unlikely given their current rate of 6.875%. In this case, all costs were rolled into a new loan balance of $616,000, increasing it by $36,000, and that explains why no cash was required at closing. A better approach might be to refinance to a rate only slightly lower than the current 6.875%, still reducing both the monthly payment and lifetime interest, but without dramatically increasing the loan balance on the new loan. Refinances can continue as long as rates are expected to decline, and the best time to pay points is in a final refinance when rates are no longer expected to drop, so the benefit can be locked in for the long term. I'm Harrison Johnson with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.